Good morning, Jags. This is Fahad. Today is Thursday, February 4th. Let's get started. Last night in Telegram, I touched upon crude oil and I showed the long term weekly chart of crude oil. And I mentioned that crude oil that continues to gradually break out for 3 consecutive days and is now touching $56 per barrel. That's the WTI crude oil. Why is it so hard for everyone to think that it won't go to 70 or even $80 per share? I see that as a potential real possibility that it could happen. And so, along with that discussion, I also showed a lot of charts of other companies that should benefit from such a rise in crude oil, including EOG Resources, Pioneer Natural Resources, and Continental Resources. I'm sure those will not be the only ones, but the entire group should get re-rated. It should also be noted that crude oil, given the underperformance over the last several years, now represents all the energy sector now represents only 2.5% of the S&P 500 weighting. It has shrunk to what used to be more than 10% of the entire index to now only 2.5%. So it doesn't even move the needle for the S&P 500 anymore. And and then the reason for that is because all the tech stocks, mostly the FANGs, the big cap names, have basically taken the leadership position, with top 5 tech stocks representing more than 26% of the S&P alone. Here's the long-term weekly chart of crude oil. This is exactly the chart that I showed. You can see how beautiful weekly candle we have here on this chart. And so the question is, as it starts to clear through all of this congestion level around 56, 57, 60, is it really hard for many to conceive that it could get to 70, 75, $80 per share, possibly by the end of this year, maybe by the summer this year? So let me just explain some thoughts over here. I am going to literally go to the Jaguar first quarter outlook because sometime a refresher is needed. And I'm going to just word by word read exactly what we said in Jaguar first quarter outlook. And so here's the page for that. Some of you are pretty familiar with this story, but sometimes it just needs a refresher. So just hear me out, and maybe a picture will start to form in your mind. It's important to note that shale well output tends to quickly decline after an initial spike. So during normal times, shale companies have to continually drill new wells to maintain production. But because of the pandemic, for which there is no equivalent precedent in modern history, everybody is erring on the side of extreme caution. Hence, the steep, exaggerated capex cuts mentioned in the introduction. Drilling a well usually takes weeks and months. If these major US and OPEC players are cutting investments by 50% year over year, it implies there's going to be a frantic waiting period for wells to come online and sufficient output levels to be reached if they are ever forced to react to sudden demand ramps from excuse me to sudden demand ramps from earlier than expected inoculations, reopenings, return of travel, etc. If Biden moves to limit drilling, as he has promised, early in his term, while global demand kicks back in, this will only intensify the above imbalance scenario. With the green energy movement and all sorts of virtue signaling going around, it's becoming harder to secure loans for drilling from lenders and private equity. As examples of curtailing, see all of these research notes from JP Morgan, Bank of America, Goldman Sachs, and Deutsche Bank. As financing continues to tighten while all demand recovers, it will fall on drillers with stronger balance sheets and or US excluding ex-US players to pick up the slack, a tall ask, while the rest will be forced to rethink ways to raise cash and be more fiscally responsible. Because of loans are no longer a guarantee, then priorities may shift towards building cash reserves rather than the output, especially for the smaller mid-sized players, as they have relied heavily on securing loans via the value of their undeveloped assets, also known as reserve-based lending, which logically would be the last kind of loan any woke bank would want to be associated with. Lastly, and this is probably the most subjective point of the bunch. We are currently in a market environment where 80% of daily volume is algorithm driven, and there is a huge emphasis on momentum chasing strategies. The recent oil flash crash and the spike in lumber futures, the melt up in EV stocks, triple digit opening day returns in IPOs, they are a testament to this. Knowing this, if oil prices start to increase from overly conservative producers unable to reverse their capex cuts fast enough to meet escalating demand, do I think prices are going to increase slowly or gradually and gradually? Nope. I think it's more likely prices are going to move violently and even overshoot past equilibrium in a short space of time when algos and retail traders tripping over each other to get in on the action. And that's typically when sell side comes strolling in and declaring a stock or commodity has gotten too expensive after they have missed the move. It often happens. This is from the Jaguar first quarter 2021 outlook page for about the energy sector. Three or four bullet points over here that are really worth mentioning. Now, why do I bring this up? You know what this highlights? This highlights the most important thing that you need to keep in mind, which is inventories have been cut everywhere. Capex have been cut everywhere. Demand is picking up everywhere. There is a potential for a massive squeeze in crude oil. Now, if you want to see an example, if it's playing out already in any industry, all you have to do is take a look at what's happening in the chip industry. As you know, the news is pouring every single day that there is a massive shortage of semiconductors, chip stocks. In fact, that led to General Motors just yesterday shutting down four of its plants because they cannot source parts to make cars. This morning, Jonathan Rigby is one of Jack's clients who's probably listening to this, sent me this email about 40 minutes ago. And he said, in his email, "Hi Fahad, quick update. Broadcom lead times are now at 52 weeks. This is unheard of. NBN in Australia now stopping new customer installs due to lack of chips for modems. Issue seems to be silicon wafers." There was much more to that email note, but I just wanted to point out that this is exactly what happens when demand comes back viciously while everybody, because of the pandemic, have cut capex deeply. And as a result, you find yourself in a significant imbalance in the market between supply and demand. We saw this happen, precisely this happen already in the lumber market. It's already happening in the chip market today. Why do you think we had this massive surge in random in the random length lumber futures last year? Because the housing demand picked up because of the migration from urban areas to suburban areas while the facilities were shut down and there was just not enough lumber production going on. We saw exactly the same thing happen in copper futures. Copper futures are at 7-year high for that very reason, because productions were shut down because of the pandemic, but demand was outstripping supply materially. Why can this happen in crude oil? And if you go with that logic, and by the way, OPEC is also not in a hurry anytime soon to start raising prices. Not any time to start raising prices. So why couldn't crude oil go to 70, 75, $80 per share, maybe even higher than that on a massive squeeze? And if that happens, that's when you have to start thinking about that EOG resources, which is trading at 55, which used to be at 110, 120, $130 per share. Could this potentially double? If you look at the daily chart of EOG, which popped very nicely 9% yesterday, this is potentially beginning of a new leg higher that can carry the stock to 65 to 70 or more. PXD Resources had a big bullish engulfing rank candle yesterday. This is popping. CLR had a big bullish engulfing candle yesterday. This is popping. Or just take a look at XOP. This is a beautiful looking chart of XOP. This is starting to once again take a next leg higher. That's what I wanted to lay out. I've been discussing oil sector now for several months now, but sometimes it's important to put it in context of what could potentially happen in months and quarters to come. That's it from me. Let's go to Jay.
Morning, everyone. So I'm going to have a homepage write-up on a company called EVRI Holdings, ticker EVRI. They provide gaming equipment and technology solutions to the casino gaming industry. It operates through two main segments, games and fintech. If we go back to last Tuesday, January 26th, the company did pre-announce some Q4 results, and that was net revenues were coming in at 117 to 121 million, which was ahead of estimates at 112 million, and also up 4 to 8% sequentially. The company's geographically diversified revenue mix likely helped mitigate the impact from select state reclosures and restrictions. Now, then fast forward a few days later, there was a note out from Ehlers Fantini, specifically the Ehlers Fantini Slot Survey, which is the leading quarterly survey for slot manufacturers. This Q4 report surveyed 150 gaming operators, 131 of them being across North America. And ultimately, it showed market-wide slot shipments trending potentially better than expected. Now, in the write-up, I'll give more data and how this relates to EVRI, but nonetheless, a positive note. And then earlier this month, or actually I should say in January, in early January, there was a note out from Stifel, a 2021 outlook for gaming, where they noted that on the fintech side of the business, they continue to see a compelling and somewhat misunderstood cashless gaming growth opportunity. They say while still early, initial market share indicators are encouraging, with EVRI announcing installations of their mobile wallet solution at the WinStar World Casino and the Seminole Hard Rock Hotel and Casino, as well as a rollout to other Seminole locations, including Hard Rock Tampa in Q1. These are among the largest and most profitable casinos in the US, which we think speaks to the merits of EVRI's mobile wallet solution. We believe the market has yet to ascribe any material credit for the long-term growth opportunity for cashless gaming at these levels. So that is another focus area that I will have in the write-up. And then the last point that I will make is that yesterday we did see call buying show up in this name, specifically in the February 15 calls, the March 17.5 calls, and probably the most interesting and most notable in the June 15 calls, where we saw 2,000 contracts bought for up to $2.30 offer side. So keep an eye out for this homepage write-up later today.
Yeah, excellent update on this one. Really looking forward to your article. And beautiful technical breakout, and we got surge and call option activity. So it brings together a perfect picture of fundamentals, technicals, and option activity, the three-prong approach. Overall, this stock traded almost 9 times daily average call volume yesterday. So it was a pretty strong day in terms of the flows, and a nice breakout and chart too. So looking forward to exactly what else you have in that article. And the casino gaming sector also goes back to the same point about reopening themes. So this should be a beneficiary from all those trends. Great stuff. Chronicle.
Morning. I have a preview of the next Jaguar Media video that I'm currently working on, but in all honesty, I think this trade can be put on right away. So I'm going to give the entire bull case right now, and then we'll just flesh it out in the actual video. So in a lot of ways, this idea is a continuation of my recent bullish call on the rare earth metals ETF, which I brought up back in November. A trade which I exited earlier this week because I think the bull case for owning the Asian players within the index is starting to get weaker. However, on the other hand, I think the bull case for owning the North American and Western Hemisphere players is just getting started. So for this trade idea, I'm recommending a SPAC merger called MP Materials, which is currently a combination with Fortress Value Acquisition Corp. Ticker for this is MP. To give a quick overview, so this company produces an extract that contains roughly 15% of the world's annual rare earth content consumption, and they're doing so by operating the Mountain Pass mine. which is the only integrated rare earth refining, processing, and mining site in North America. I repeat, this is the only integrated rare earth mining, processing, and mining site in North America, with proven reserves totaling just under 20 million tons. And in terms of specific elements that Mountain Pass contains, there's lanthanum, which is used in rechargeable batteries, as well as the lenses that are found in cameras. And then there's cerium, which is used in automotive catalysts and LED lights. Apart from those, the company also produces two very important concentrates. The first mixture is a combination of neodymium and praseodymium, which is a crucial substance that is used in the production of permanent magnets for EV motors and wind turbines. And additionally, it's also found in modern smartphones and mobile devices. And then the second concentrate, which is a combination of samarium, europium, gadolinium, terbium, and dysprosium. That compound is used in a lot of lasers and medical devices, and also, again, in permanent magnets. Now, in the case of dysprosium and samarium, apparently China currently supplies about 98% of dysprosium and samarium globally, and these are key components for, as I said, permanent magnets and industrial uses. And then for rare earth metals in general, we can see from this graph that, which I already shared back in November, just how reliant the entire supply chain is on China right now, which is why China's control over rare earth exports should not be taken lightly, because if they decide to weaponize this as a way to gain the upper hand in geopolitics, like what they did to Japan back in 2010, that's going to send the prices of these rare earths skyrocketing and create all sorts of issues, because even though there are deposits outside of China, it does take time to set up the infrastructure for mining. And so that's going to cripple entire supply chains, especially those that rely on just-in-time inventory. So here's the core of my bull case, which is split between what's happening in the US right now and also what's happening in China. Let's start with the US. So several months ago, back in October, Donald Trump signed an executive order declaring a national emergency in the domestic rare earth mining industry. Essentially, Trump ordered his cabinet to look into giving grants and funding via the Defense Production Act towards reviving and boosting national production of rare earths. And the way that he was able to link this to the Defense Act is that these elements are also used in the production of hypersonic missiles and weapons. Now, fast forward to the present, just this week, news has emerged that President Biden is preparing an executive order requiring the government to review the supply chains for medical devices, critical technologies, and the military. Obviously, this is going to involve rare earths. So basically, Trump has laid out the foundations by looking into incentivizing domestic rare earth production. And then now Biden is overlaying that with a review of supply chains. So I don't need to stress how much of a game changer this combination will be. Okay, now looking at China. So last month, China's government published 7 pages of draft legislation, which is reportedly aimed at stepping up regulation over the supply and production of rare earths. And looking at National Mouthpiece, China Daily's article regarding this story, this was how they worded it. Quote, China will reinforce the protection of its rare earth resources and strengthen its full industrial chain regulation, unquote. So this is very telling because China says full industrial chain. What they're implying here is that their intention is to establish greater influence over the global supply chain, not just domestic. So naturally, that's going to result in greater influence over the Western Hemisphere, and especially America, because the US currently imports 80% of its rare earths from China, which is something that the US will want to suppress. So putting this together, I think it's pretty obvious how this company, MP Materials, should benefit from all of this. And in terms of financials, there's not a lot of history to look at in this chart that I shared, but consensus is expecting a tripling of annual revenue over the next couple of years. And then valuation wise, yes, this is an expensive stock, but the reason why this is being bid up is because the company is likely going to be in a powerful position going forward. So I'm not too worried in that regard.
Yeah, excellent case over here, bull case here, Chronicle. You and I talked behind the scenes as well as to the prospects of MP, and we both like it a lot. And you've added a lot more color to our discussion and this conversation. So this is fantastic. This is really, really good. The only thing that I will once again emphasize is what Chronicle said at the onset of this discussion, which is, once again, reminder to everybody, this is the only refiner of rare earth metals in North America. That's it. The only refiner of rare earth metals in North America, MP Materials. And for those who like to know the background, this is the same company that in old times used to be called Molycorp. Remember that? Molycorp that did the IPO many years ago, but at that time the stock fizzled, ended up going bust, ended up going bankrupt essentially, and then recently re-emerged from bankruptcy and then was listed in the market through a SPAC listing, and now we have it, MP. This is the same exact company with a far better and a stronger management than it was previously in the past. All the shareholders base have changed, everything. So that's the first thing you need to keep in mind. Second thing, the executive order that Trump signed in October, which Biden is now pursuing by taking it to the completely next level and being more strict about this and everything. And number three, as Chronicle pointed out, more than 80% of rare earth metal is sourced from China, and the U.S. wants to change that, because I actually even believe too, I agree with Trump and Biden on both of this, that this is a threat here and this needs to be changed and we need to have our own capacity. This is the pure play on that. So I would not worry about any kind of valuations over here, because this is the kind of name that can just continue to fly. Fantastic stuff here, Chronicle. Thanks for adding all the colors. So all right, folks, we're going to stop over here. Thank you very much for joining. We'll see you in the chat room shortly.